In this video, I'm going to basically guide somebody who is brand new to investing how to choose a good stock based on some of the metrics that you find when you look at the statistics for a stock. So the first thing is the earnings per share, also known as the EPA. And essentially, if that number is positive, it means the company is making money or expected to make money for the quarter. If the number is a higher positive number, say 5, 6, 7, you know that the company seems to be making, it's expected to make more money for the quarter. And if it's a lower positive number, say 1, 2, 3, and I'm just rounding to simple whole numbers, it's going to be a decimal number most of the time, then you know the company is just making a little or expected to make a little for the quarter. Naturally, if the number is negative, it means the company is losing money or expected to post a loss for the quarter. So the higher the negative number, which means like if it's a -1 or 2, the company is losing or expected to lose a little money. And the lower the negative number, like if it's -5, -6, etc., then the company is expected to suffer a major loss for the quarter. So you want to look for stocks which have a higher estimated earnings. And this way you know that a company is actually making money. You want something at least with a positive estimate earnings. Now another metric is the price to earnings ratio, or PE ratio. So the lower the number, the less the premium on the stock price. The higher the number, the higher the premium. And I'll explain these premiums, what I mean by that. For example, we'll use silver as an example. If it's $15 an ounce, and you can buy a silver eagle dollar for $18 per ounce, basically 18 minus 15, so they're charging a $3 premium over the spot to cover the cost of manufacturing of the coin. A generic round, something made by a private company that doesn't have a monetized value, they may charge you only $17 per ounce. So if silver is $15 an ounce, then 17 minus 15, they're only charging a $2 premium over spot. Now, when you have vintage rounds, like say some old Engelhard rounds, a coin dealer may charge you 18 per ounce. So even though it's a generic round, you see there's an increase in premium for that particular type of round. So essentially, the lower the premium, you're basically buying the coin closer to the value of the metal inside it. And the same thing, when the lower the premium, you're buying the stock closer to the book value. Now, it's basically a good potential for a stock to gain value. So a lot of people, they look for stocks that only have a price to earnings ratio close to 10 or less. The higher premium, the stock may be overvalued, but certain stocks are in greater demand, just like how people prefer the Silver Eagle. It's more trusted than something generic, so it tends to have a slightly higher premium. So it may be popular and commands a higher premium, or there could be a lot of hype which has driven up the PE ratio, and then it's not necessarily a good buy, and it indicates it could drop in price. So this is something you have to really read some news articles and study just to be safe. So you want to look at the stock price over time as well. So here we have a chart, and you can see that the stock, it basically is showing a rising trend. In this case, you have a decreasing trend as indicated by the downward trend over time with the red line to show like that's basically smoothed out of the regular fluctuations in stock price. So here we have both a rising and decreasing, and as you can see, you want to buy low and over time have its value increase, and that is a good thing. Decreasing trend is not necessarily a good thing, but when the stock goes down in price, it means you can buy it at a better, you can buy more shares for the amount of money. And you want to know if the decreasing trend is um, just an anomaly or if it's something systematic with the company itself. And reading a lot of news articles can help guide you in that regard. But sometimes you read one article saying praising a stock, another one dissing the stock, and both posted on the same day. So really, if you do research with news articles on a certain stock, don't accept what these people who write the articles are saying as pure doctrine. You want to just get some information to help guide you, but not necessarily let those articles steer your decision. Now we get to dividends. If a company doesn't pay dividends, you want to sell it at a higher price to reap profits. If a company pays dividends, you're basically making money and generating cash flow while owning the stock. So being paid from the company's revenue as part of a owner in the company is what's happening. So really, since you own part of the company, you're making money from that. So you reap in profits while retaining ownership of the stocks, and you can also reinvest the dividends by purchasing additional shares every time you get paid dividends. And this way you actually grow your investment in the company. You can also cash out the dividends as income. This is advised maybe in retirement, but until you retire, just keep reinvesting and just let the dividends compound. So if a company decreases their dividends over time, your percent return in the dividends will decrease over time. So if they paid $1 and the stock was worth $10 a share and now it's worth, $10 still, and they're paying 50 cents a share in dividends, you started when you bought the stock, you were getting a 10% return, and now you're getting
a
and these
5%
are just
return.
rough numbers. If a company maintains dividends over time, then your gain increases similar to that of compounded interest in the bank. If the bank pays a 5% return in a CD account, then basically it's just, an expected return. Now, if a company increases the dividends over time, your percent return increases over time. So you buy a stock at $10 a share, they pay $1, and I'm just keeping the numbers simple, And then after owning it for 10 years, now it's paying $2 a share in dividends. Then what you're doing is basically started out getting a 10% return, now you're getting a 20% return. Now, realistically, to get that high percent of return starting out, of 10%, you want trusts, and they don't necessarily increase over time. The growth stocks, they usually give you 1 to 2% on average. But the nice thing about increasing dividends over time is that it amplifies your percent return over time. Now here we have a chart, and we're going to show you decreasing dividends in blue, increasing in green, and if the dividends were steady in orange. So as you can see, this is a very slight downward gradient in the, for companies gradually decreasing their dividends. So your percent return on the stock decreases over time. And we drew a nice red line to show you the downward trend. Now here you can see that over time this company has been maintaining their dividends. So you do have a slight upward trend, and it's in a predictable fashion. Now if a company increases their dividends and you reinvest the dividends and it compounds, you can see that it starts to go parabolic after several years, and the gradient is much steeper. So now looking at all three, you can see that on the far right after 15 years, if a company increases its dividend, it's a lot higher than if they just maintain their dividends. So you get an amplified return over time. So your profit increases in order of magnitude as opposed to gradually. So here are the trend lines drawn for each one. And here are just the trend lines. So as you can see from the right, the gap between the top line and the medium line is a lot greater than the medium and the bottom because of the order of magnitude increase by reinvesting the dividends in a company that increases their dividends over time. So here's the chart again, just for you to ingest the information. And now we get to share buybacks. And this is something that Warren Buffett likes even more than dividends. So, sometimes companies may sell new shares, and it results in you having a lower percentage of ownership in a company. So if you own 10 shares out of a total of 100 shares that there are for a company, for example, I'm just keeping the numbers simple here, there are usually thousands and millions of shares, then you own 10% in the company. Now, if a company sells an additional 100 shares, now you have a total of 200 shares, and you own 10 shares out of a total of 200, you now own 5% in the company. So when a company sells new shares, it results in you owning a lower percentage of the company. If a company uses extra cash to purchase their own shares, however, then it results in you owning a higher percentage ownership in the company. So if you own 10 shares out of a total of 100 shares and you own 10% in the company, now if they buy back some stocks, let's say they buy back 50 shares, now you own 10 shares out of a total of 50 shares that the company has or that are outstanding. So now you own 20% in the company. So as you can see, when companies buy back their own shares, it gives you a higher ownership or higher stake in the company. So it helps you reap a higher profit in the future. And it also helps where the dividends can also grow and sustain and increase in dividends over time. So in summary, we have the earnings per share, which means the higher the number, the more profitable, so the better. The price to earnings ratio, and between 10 or lower, then it's closer to book value. It gives good potential for it to increase in price. Of course, sometimes some stocks intrinsically trade higher, so you just need to monitor that. And dividends, as long as a company pays their dividends and if they increase it over time, it helps generate cash flow and long-term growth. And with them increasing, it amplifies the growth. And share buybacks, that's the thing that Warren Buffett likes the most, and it allows you to own a higher percentage stake in a company. And thanks for watching and happy investing.